Readers of Cantech Letter are familiar with Hamed Shahbazi. Many will know him as the founder of TO Networks, which he eventually sold to PayPal. Others will know him as a multiple winner of our Cantech Letter Awards. Today, however, he is best known as the architect behind Well Health Technologies, which has, in just a short period of time, become a major player in the Canadian tech landscape and a household name. The company has professionalized and upgraded a Canadian healthcare system, which was in obvious need of such things. Along the way, he enlisted superstar investor Sir Li Ka-shing, who took a huge stake in the venture. In 2020, it all clicked. Well became one of the top performers on the entire Toronto Stock Exchange, which it had graduated to with unrivaled dispatch. Mr. Ka-shing's abundant fortunes became even more abundant with his Well Health investments. And perhaps most impressive of all, Shahbazi's company spawned nothing less than an entire digital health sector in Canada, with copycats and lookalikes populating various exchanges and pouring hundreds of millions of dollars into Canadian digital healthcare. If you did not know Shahbazi, you might expect him to be resting on his laurels and basking in the success of his third major tech venture. TO Networks and BBTV proceeded well, but no one who has ever met him would expect that of him. Please welcome Hamed Shahbazi. Thank you for joining us, Hamed. Can you give us an update on Well?
Well, thanks for asking. We've just had an outstanding year. The business is extremely healthy, thanks mainly to our strong financial discipline. We recently announced our Q4 results, which analysts were initially looking for us to break even, but we posted close to $800,000 profit for the quarter on the back of better than expected organic growth from our digital portfolio. And might I say that actually brought us to about break even for the full year, which was way ahead of forecast and consensus. Our M&A program's also been quite active. We've made a number of really strong acquisitions so far this year that really reflect our strong fiscal discipline. For example, we purchased an electronic medical records SaaS business that was generating around $9 million in revenues, of which most of that revenue was subscription SaaS revenue. This company is growing nicely and is quite profitable. We acquired this business for just north of 2 times sales, which is pretty incredible in this kind of environment. We just completed our largest acquisition to date, a company called CRH Medical Corp, previously a New York Stock Exchange listed and a TSX listed company. We actually just completed that on Thursday this past week.
So does this acquisition imply that Well has ambitions that extend beyond the Canadian border?
Absolutely. It gives us size and scale across both sides of the border. We'll have more than $100 million in revenue in both Canada and the United States, and strong, profitable, growing businesses on both sides. And that's quite a unique attribute. Not many companies can say that. CRH recently had their own Q4 revenues because, again, they're a listed company, and they announced that they had increased their Q4 revenues by 21% on a year-over-year basis. So they generated over $36 million US in Q4 revenues and generated over $11 million in shareholder level EBITDA for the quarter. So implying more than $40 million US yearly in EBITDA. So when you combine that with Well's own, performance, we're approaching about $300 million on a combined basis, with more than $60 million Canadian in EBITDA. And what's really great about CRH as well, beyond the financial profile, is that it gives us a phenomenal channel in which to sell our products and services. So Well has made numerous investments in areas such as digital patient engagement, data protection and cybersecurity. And, we'd like to expand the 2 products and services that they have today. They provide hemorrhoid banding and sedation services with anesthesia services to GI practices and ambulatory surgical centers. We'd like to expand those 2 products to 5 products. And that's going to be, again, data protection services. Each one of these clinics and ambulatory surgical centers need data protection. Each one requires digital patient engagement, online patient booking, mobile check-in, telehealth, even, GI doctors do need to see patients virtually at times. And third, we really believe a chronic disease care platform to help GI doctors and their patients become more healthy is really key, because GI doctors deal with a lot of chronic disease types of ailments like Crohn's, colitis, IBS type elements. So this just gives us a phenomenal opportunity to sell and promote our digital products and services in a large and growing channel. But that channel by itself is growing and very healthy. CRH has made 33 of their own acquisitions, and they've been remarkably consistent. They've been buying at about 4.5 times EBITDA on a blended basis. And so really, really consistent. And the vast majority of those acquisitions have continued to grow organically. We extensively due diligence CRH. We hired a top team at KPMG, their healthcare group that did a forensic level of due diligence, really, looking at all the data, downloading all the EMR data from all the different platforms, and really scrubbing them. And we also hired a number of other professional advisors to really dig in, from regulatory to legal to other. And so we're incredibly thrilled with this transaction. We think that the company is very strong and very well managed, and will be operating distinctly as our 7th business unit.
That's fantastic. And Hamed, there was a recent short report written about your company. Tell us a little bit about that.
Sure. I mean, listen, based on our review, the report contains gross errors, omissions, factual inaccuracies. It's basically one of these short and distort type reports. So at this point in time, it's definitely not even worth dignifying it with a response in terms of rebutting it. But listen, we had enormous feedback from our shareholders, analysts, and investors, commenting on their support for the company and the fact that they see this report for what it is, a misleading report designed to, manipulate the market for the benefit of people who have short positions on the company. And to that end, the report does disclose that the writers do have a short position on the company, and that their work is based on their opinions, not facts. So it's basically an opinion piece. They also note that they make no representation to the accuracy, timeliness, or completeness of their work. They also make it clear that their friends, investors, and clients could have substantial short positions that favor, the fact that they would make money if there was a decline in the stock price, and again, realize significant gains in the event that their campaign to misinform works. So they're clearly acting in their best interests as a short seller and to the interest of their clients. When you look back on yesterday, which is when this report came out, we had enormous volume and ended the day almost flat, which doesn't usually happen with these types of reports. I think this happened for the reason because we have a lot of investors that got into the market and bought our shares because they saw a buying opportunity, given the false and misleading information the report portrayed. What kind of a report doesn't even have an author noted on it? In fact, Andrew McCreath, a well-known, Canadian institutional investor and BNN Bloomberg commentator, even commented on air on BNN about Well yesterday and this short attack. He actually noted that he's aware of the research company and the fact that they carry out these sorts of research projects as paid assignments for hedge funds that carry these massive short positions.
Okay, and Hamed, we do have a clip of that, so let's play that right now.
Now, what is raining down today is the trading volume on a stock here in Canada that was a favorite last year. I think it was up fivefold last year, 500%. It's called Well Health. Ticker is WELL. It's traded 3.5 times its average daily volume based on a short report that came out of the United States today. The individual, who of course remains anonymous, calls himself Grizzly. But I know that he happens to be one of these report writers who gets paid to write reports, something that I don't understand why regulators don't look at hedge funds hiring people to write short reports. Of course, the hedge funds are going to get short before the report gets published. And I'm not going to opine on the report at this point in time. But bottom line is the stock's not down that much. It's only down about 3% today, but on heavy volume, Greg.
Okay, Hamed, now listening to that clip, what do you make of that?
It's really incredible if you think about it. Hedge funds anonymously paying third-party research writers to try and damage a listed company's reputation just for the sake of their own profits. It's quite a toxic business model, and meanwhile, well management, including myself, has not sold a share while continuing to buy in at varying price points, including the latest subscription receipts financing at $9.80 per share. Which at the time that we did the acquisition and the placement reflected a 25% premium to the then trading price. So I've personally purchased millions of dollars of stock with my personal funds, and recently purchased $530,000 at $9.80. We were at $6.95 yesterday where we closed, and I've never sold one share or even taken $1 of cash salary since the inception of the company. So, you can, and I'm the closest to the company and I can see what's going on in the company. So, clearly in a very different vantage point. So I think it's important for people to consider, the people most closest to the business that are insiders that are seeing the quality of decision-making and the quality of the business are the ones that are supporting the business and are investing in the business.
Well, how does that work? Don't regulators look at this kind of stuff?
Sadly not. And it's a real crime, what hedge funds and short sellers have been able to get away with here without regulators stepping in. In the industry, at a number of these investment banks, you have many reputable research analysts who have extensive qualifications and designations and do a ton of work when they write research reports. They interview management, they speak to customers, they build valuation models. They have compliance departments that review their work ad nauseum before the analysts can give any kind of a recommendation on a stock. And then you have hedge funds secretly building up short positions in a company, and then they start anonymously posting negative comments on bulletin boards and social media, and anonymously paying research companies to again distort information and write these opinion pieces against the company. The researchers don't have any compliance requirements, no fact checking, zero compliance requirements. How is that fair? We don't think it is, and we think it's time for reform in this area. And it's something that I know has been talked about before with the regulators, but we really think the time is now. Think about it. When investors see this short report, it induces fear in the market and selling, and that's when the short sellers jump in and either cover up short positions that have already been created and cover, or they look for further decline to make more money. And in our view, the regulators should require the short report author to provide their name and credentials. The firm that puts out the short report should disclose who paid them to write the report and whether or not the group paying the researcher is long or short on the stock. These are just sort of fundamental things that should be known when these types of research pieces go out there and people are reacting to this kind of information.
So what can public companies like yours do when you do get hit by a short attack?
Well, Well's really fortunate in this case because we have a fantastic shareholder base, and we can recover a bit easier. It's still obviously not great to be attacked in this way, but we have 10 analysts covering the story, all with buy recommendations right now. And we've had some time to spend with them, and we'll continue to do so. And they're confident in their research. They're confident in us. We've spent a ton of time with them. They've done an incredible amount of independent analysis and confirmation. So there's a lot of integrity and rigor in the work that they've done. But a lot of other companies aren't so fortunate, and in some of those cases, some of these companies take a really big hit, and some don't recover for a very long time. And both institutional and retail investors end up suffering, pretty badly. I especially, feel for retail investors. Some are investing funds that they're really, counting on, like their retirement funds, and getting hurt by these types of things.
Is this the same situation as the GameStop stock?
That's exactly what this whole GameStop Reddit thing was all about, that we saw earlier this year. Retail investors saying, hey, enough is enough. We're tired of these, shadowy, rich kind of hedge funds and short sellers manipulating the markets for their own benefit. It's kind of the retail investor rising up and fighting back. And now retail investors have the kinds of tools and means to do so, given the use of technology, social media, and the access to information. I would still say that they're at a disadvantage compared to all the tools that the hedge funds have, especially with the lack of regulatory oversight that we see out there. But at least now, the sort of the little guy and gal is able to rise up a bit, given some of these ability to kind of band together.
And why do you think Well was targeted? We mentioned in the intro how you're kind of a pioneer in this sector. Do you think that's played a role?
Yeah, I mean, listen, I think we've been a fairly high profile stock in terms of, some of the factors that such as the substantial increase in our share price. We've had a pretty aggressive growth path. We were really kind of the first stock in this digital health, space that really got out and took up a lot of oxygen. And there's a lot of liquidity in our stock, a lot of institutions, a lot of retail. All these types of factors play into, attracting the attention of one of these types of situations.
So what's next for Well now in 2021? What can we expect from you?
Yeah, I mean, listen, we're just going to continue to execute. We'll not let these types of reports and baseless attacks distract us. We're going to continue to experience strong organic and inorganic growth, and we have a very robust pipeline of acquisition opportunities, organic growth opportunities, and we're here to build an amazing company. We're a purpose-driven company. We're empowering patients and practitioners. And we're really kind of leading the charge here in the digital health space. So we feel much like missionaries. And if you think about it, it's really incredible that the kind of tactics we just talked about have been deployed against a company like ours. That's really making a difference. It's really helping practitioners become more efficient and deliver better care and improve patient outcomes. And so we're not discouraged. We're extremely excited, and don't bet against Well.
So I've read that you're a big proponent of a do the right thing type of culture in all the companies that you founded. How do you think that type of culture and mindset has played a role in Well's success?
Yeah, thanks for asking. Listen, it's I think played a huge role in our growth and enthusiasm behind the company internally, externally. We've heard a lot in corporate development situations that companies are looking at Well as an aspirational, buyer of their company. So even in situations where they have an opportunity to sell to someone else, they prefer to sell to us, even sometimes with inferior, terms. We've seen that with people that want to come over and work for the company. I've always felt, not just at Well, but in my previous company, that, everything is a product of culture. It's not that culture is a product of your strategy or product of your products and services and software. It's the inverse. Everything comes from culture, because a do the right thing culture is inclusive. It's about bringing people together. It's about being purpose driven. I'm just thrilled that we enjoy the kind of recognition that we do in this over time. After many years of practicing this kind of an approach, it does spill over, and I'm really committed to that. I'm really committed to defending that. It's a big part of what we do every day, to really protect the cultural disposition of the company.
Well, it sounds like we can expect big things from you.
Thank you. We're certainly going to try.
Thank you so much for your time, Hamed.
Thank you for having me. Really appreciate it. Great conversation.
That was Hamed Shahbazi, founder and CEO of Well Health Technologies. Thank you for watching. We'll see you next time.